What if putting more money into your SRS account could actually cost you more in taxes later? Hmm, that sounds backwards, right? The whole point of SRS is to save on tax. You put money in, your taxable income drops, and everyone tells you it's one of the smartest moves a working Singaporean can make. So how could saving more inside SRS possibly work against you? Here's the situation. You're maybe 35, 38 years old. You've been diligent. Every December, you top up your SRS account right up to the cap because your CPA or your colleague or some finance influencer told you it's free money. 10 years pass, 15 years pass, and one day you check your SRS balance and it's sitting at $200,000, $300,000. You feel proud. You should feel proud. But there's a problem waiting for you quietly at the other end of this account, and almost nobody talks about it. Let's rewind for a second, because to understand the trap, you need to understand what SRS actually is. The Supplementary Retirement Scheme lets you contribute up to $35,700 a year if you're a Singaporean or PR, and that amount gets deducted straight from your taxable income. Contribute $15,000, your taxable income drops by $15,000. It feels like a discount on life, and it is in the short term. But SRS was never designed to be a savings account you fill up and forget. It was designed as a retirement drawdown tool. Money goes in tax-free, money comes out partially taxed. Only 50% of your withdrawals get taxed, and only after you hit the statutory retirement age, which is currently 63 and rising. That's the part people remember. Only 50% taxed, that's still a win. And for a modest balance, it usually is. But here's where things start to get interesting. The government gives you a 10-year window to withdraw everything from your SRS account once you start. 10 years, not indefinitely. If you don't finish withdrawing within that window, whatever's left becomes fully taxable at 100% in that final year. So the strategy isn't just save into SRS. The real strategy is save into SRS and then withdraw it in a way that keeps your taxable income low enough year after year that you don't accidentally push yourself into a higher tax bracket. This is where the trap quietly forms. Let's say you've built up $400,000 in SRS by the time you retire. Sounds great. You decide to withdraw it evenly, $40,000 a year for 10 years. Half of that, $20,000, is taxable each year. Now stack that on top of your other retirement income, maybe CPF payouts, maybe rental income, maybe part-time consulting. Suddenly, that $20,000 isn't landing in Singapore's 0% bracket anymore. It's landing somewhere in the middle, taxed at 9, 11, maybe 15%, depending on what else is coming in that year. Now picture the version of you who kept contributing aggressively for another 10 years, chasing the tax relief every December without ever mapping out the exit. Your SRS balance balloons past what you can comfortably withdraw within the 10-year window without spiking your tax bracket. You end up handing back in withdrawal tax a meaningful chunk of the very savings you thought you were protecting. That's the trap. Too much money in SRS, withdrawn too quickly or withdrawn without a plan, quietly erodes the advantage that made SRS attractive in the first place. So how do you avoid it? Let's walk through this properly, because the fix is actually simple once you see the shape of the problem. First, understand that SRS relief is most valuable when you're in a high tax bracket now, and withdrawals are least costly when you're in a low tax bracket later. The entire strategy is about that gap. If you're currently earning, say, $120,000 a year, contributing to SRS might save you tax at a rate of 15 or 18%. If you plan your withdrawals well in retirement, spreading them out so your taxable SRS income each year stays low, you might only pay 2 or 3% tax on the way out. That gap between what you saved going in and what you pay going out is the entire value of SRS. Contribute without a withdrawal plan, and that gap can shrink to almost nothing. Second, don't automatically max out your SRS contribution every year just because you can. This surprises people. The relief is capped at $35,700, but that doesn't mean everyone should contribute the full amount every single year. If your income is only moderate, the tax you're saving today might be smaller than the tax you'll eventually pay on withdrawal, especially if your SRS balance grows large enough that it can't be comfortably spread across 10 years without pushing into higher brackets. Third, plan your withdrawal age and withdrawal size years in advance, not the week you retire. A good rule of thumb many planners use is to keep each year's taxable SRS withdrawal, remember that's half of what you take out, low enough that it stays close to the lower tax brackets, ideally under the $20,000 mark, where rates are still very low. If your balance is large, that might mean starting your withdrawals as early as possible after the statutory retirement age, spreading it evenly and coordinating with other income sources so nothing stacks awkwardly in the same year. Fourth, and this is the part almost nobody considers, think about combining SRS withdrawals with lower income years. If you're planning to reduce your work hours gradually or take a year off or shift into lower paying but more meaningful work before full retirement, that's actually a golden window to withdraw a bit more from SRS because your overall taxable income that year is naturally lower. Timing your withdrawals around your income dips, not just your age, is one of the most underused strategies in Singapore retirement planning. And there's a fifth piece worth understanding because it trips up even people who think they've planned carefully. Investment growth inside SRS counts too. Many people forget that SRS funds aren't just sitting in cash, they're often invested in unit trusts, ETFs, or stocks, quietly compounding year after year. That's usually a good thing, but it also means your withdrawal balance can end up much larger than your contribution total, simply because the money grew. So if you contributed $200,000 over the years, but investment returns pushed the account to $350,000 by retirement, your 10-year withdrawal window now has to handle that larger number, not the smaller one you originally put in. Factor growth into your withdrawal math early, not after you've already retired and the balance surprises you. So here's the shift most people never make. They treat SRS like a piggy bank. Put money in, forget about it, break it open in retirement. But SRS behaves more like a pipe with a valve at both ends. One valve controls how much tax relief flows in, the other valve controls how much tax flows back out. If you only ever think about the first valve and never plan the second, you can end up with a very full pipe and a very narrow 10-year window to drain it. And that narrowness is exactly what pushes you into higher tax brackets you never intended to hit. The good news is this is completely avoidable. It just requires thinking about SRS as a two-part decision instead of a one-time contribution. Ask yourself not just how much can I put in this year, but what will my income look like when I start taking this out, and how do I keep that number low? Because the goal was never to accumulate the biggest possible number in your SRS account. The goal was always to move money from your highest earning years into your lowest tax years, quietly, efficiently, and on your own terms. Get that timing right, and SRS remains exactly what it was meant to be, one of the most underrated tools available to build long-term wealth in Singapore. Get it wrong, and the very account meant to save you money becomes the reason you write a bigger check to IRS than you ever expected. So before you make your next SRS contribution, don't just ask how much relief you'll get today. Ask yourself how you're going to take it back out. That one question is the difference between using SRS well and falling into the trap that catches so many people who did everything else right.